Why small wins in trading actually beat big wins in your trading. So this is you as a trader, and you're going to want to make all of this money that's around you that's available in the market. So it's important to understand why betting small and winning small can actually beat winning big. So with your strategy, it can be any host of different things, whether it's a break and retest strategy, support and resistance, it doesn't matter. They all work. But for your strategy, you have two main options. You can either go for a small win rate system where you target small wins, or you can go for a system that has bigger wins established with it. But to understand which one to go with and why one may be better than the other for traders, let's first understand how wins actually work in the market. So for this, I have a graph. We have the win rate that's going to be on the y-axis and the risk to reward that's going to be on the x. So for this, we understand that typically with win rate, as it increases, our risk to reward is also going to increase as well. So what does this mean? Right. So let's just say right here is a 20% win rate. Let's say here is a 40. Let's do 60. Let's do 80. And let's do up here 100. So this is meaning that here you're winning 20% of the time and losing 80%, and here you're winning 80% of the time and losing 20%. So as this win rate increases, your risk to reward, a lot of people expect for that to increase as well. And if we draw out the normal kind of distribution of trading, and of course it doesn't look this smooth, but just for example purposes, if we draw out how trading may look in a live market, then you're telling yourself, okay, great. So I want to target a high win rate system, right? And also a high risk reward system as well. So meaning that for here, this may be a 1 to 10, meaning that for every single dollar that I invest, I'm making roughly 10 when I win a trade. However, this is not how trading works at all in a live market. In reality, if I could erase this real quick and draw a better example, when it actually comes to trading in the market, is really as your win rate increases, your risk to reward here is actually going to decrease. So it's counterintuitive to what we think. So when it comes to actually targeting for your strategy, you can either have a win rate, I'm going to abbreviate it for a WR, that is high, and a low risk to reward, or you can have a low win rate and a high risk to reward. And these are essentially the two different options that traders have in the market, regardless of your strategy. Now, let's dive into which one works best and exactly why small wins actually work better than big wins for most traders. So, with a big win system, right off the bat, there's going to be two main issues. Your first main issue is going to be a low error margin. So, what does that mean? So, as we already saw from our example up here, we're picking this one down here, which is a lower win rate, but a high risk to reward. So, if we scroll back down, low error margin is essentially saying you have very small amount of error in order for you to actually make money in the market. So if we could draw a quick little example, let's say that this is the market, right? This is what the market is doing right now. And of course, it doesn't actually look like this. But let's say this is the market, and let's say that your trade is you want to get in right down here at this low, right? So this can be your entry. This up here can be your take profit. And let's switch up the colors a little bit so we have something different. And let's say that this is your stop loss, right? So this can be your trade. And if we can zoom in a little bit, if this can make sense. So obviously this margin, right? That's in between. Let's use a different color for that actually. Purple. So let's say this margin, right? That's in between your entry that's here and your stop loss, which is the blue. The margin in between is incredibly small and narrow. And let's say if you're trading Forex, for example, let's say that this margin is 5 pips, right? super tight. And let's say that this margin between your entry and your take profit is actually going to be, let's say 15. Well, that's a little small. Let's say 50, right? So for this example, you're targeting a 1 to 10 trade. And for this, you're probably going to have a lot of losses before you have wins. So let's just imagine that our risk to reward for this strategy is, let's just call it let's say our win rate's 20%. That means that out of every single 5 trades, so let's do 1, 2, 3, 4, and let's switch it up, 5. Boom. So for every single 5 trades that you have, 4 are going to be losses and 1 is actually going to win, right? But for this one that wins, you need to make sure that you execute this one winning trade perfectly, because if not, then you're probably going to be subject to another 4 losses until you get another win. And of course, win rates don't work out perfectly like this. It's over a span of time. But with a high, risk to reward system, you're going to encounter a lot of losses, right? Maybe a 20%, or, maybe something that's even lower, like a 10% winning strategy. You can encounter something that doesn't have the best numbers in terms of your win rate, but because you're targeting a 1 to 10, you can lose 9 trades in a row, right? But still be able to become profitable simply off of the one winning trade that you have, right? And that's one of the benefits of targeting a high risk reward system. But the margin of error is so small. So let's say here, instead of being able to get in your entry here, let's say that for whatever reason, you were hesitating on your trade, and your entry that should have been at this level here, you ended up getting here. So now, if we can use our eraser, so now this trade that was supposed to be, a 1 to 10, right? Because your entry is now up here instead of down here, this 5 pips turns into, say, 10, right? And this 50 turns into 40. So simply by hesitating, right? And whether it's hesitating, missing a trade, or waiting for something to confirm, you waiting and price moving just 5 pips in the market, which is not a lot at all when it comes to trading, that cost you from going from a 1 to 10 risk to reward system down to a 1 to 4. And that's still good. A 1 to 4 risk reward system is great, but you have to compare this relative to what your actual win rate is, right? And if your win rate is a 20% or even a 10%, right? This 1 to 4, even though you may win the trade, is going to lose you money over time. Why? Because with a 10% strategy, again, that means that out of 10 trades, right, you're actually going to be losing. If we can draw this out, 1, 2, 3, 4, 5, 6, 7, 8, 9. Boom. So out of 10 trades, you're actually going to be losing on average 9 of them, but being able to win 1. But with a 1 to 4 risk to reward system that we have here, that means that for one trade, this one trade is only going to equal 4 RR, right? While you have 9 RR of losses. And of course, these losses outweigh the wins. So if you do that super simple math calculation, you're going to be down 5 RR in your account. So that's one reason why having a big win system can be very detrimental in your trading, because it's a low error margin, right? Just the difference of 5 pips brings you from a 1 to 10 strategy to a 1 to 4. And that's all the difference between you being very profitable in the market or you owing the market a lot of money. The second thing is infrequent success. So just like we signaled above in our example up here, when you have a high win rate system, right? Go back to this example. High win rate system is incredible, but at the same time, we know that our risk to reward is going to go down, right? And the same thing is true if this is opposite. So if we bring out our eraser, right, and redo these, if we have a high win rate or a high risk reward system, then we know our win rate is going to go down. And going back over to infrequent success, this can be a problem for a lot of traders because instead of having a win rate that's say, 50%, where you lose roughly half of what you win, now you're having a win rate of say 10%, right? Or 15%, which is fine. You can be very profitable, but that leads to infrequent success, which for a lot of traders, this is something that can be psychologically damning and lead to a lot of losses in your trading, right? And that leads us over to our next point over here, which is potentials for large losses. So again, feeding off of the infrequent success, because you are losing trades, right? So let's just say back to the 10% example for your win rate system, because you're losing about 9 trades and only winning 1 trade out of those 9. Again, this can cause for a lot of psychological issues and damage, especially when it comes to your trade, right? Whether that's seen in the form of over trading or that's seen in the form of hesitation, it leads to larger losses over time simply because you're losing a lot of trades, and emotionally and psychologically you cannot handle that, right? So that leads to the next point as well, which is going to be long wait times. So a lot of times when it comes to high risk to reward systems or low win rate systems, which is the same thing. So let's do this, right? For win rate, let's bring this back out. Perfect. So win rate's down, but the risk reward is actually up. One thing that happens is if you miss that trade, right? So going back here, because we know that roughly out of 10 trades or 20 trades, right? Let's use 10 for this example. We know that roughly out of 10 trades, right? You're losing 9 of those trades, but winning 1. But the issue is if for whatever reason you miss that 1 trade, then you're going to have to wait for the next one to form, right? Which is, of course, leading to large potential losses, but also long wait times in order for that to set up. And a lot of traders get very jittery when it comes to their trading, right? They need to trade, they need to trade. And if they're not trading, they become upset or they feel like they're not doing anything. And that leads to over trading by simply being able to wait for your strategy to set up. And all of these leads to larger potential losses. But let's evaluate and go back to the small win system that we have over here, right? So with a small win system, you have lower risk because say your win rate is going to be around, let's just say around 40 to 50% to 50%, right? And let's say you're targeting a 1 to 3, right? That means that on average, you're going to be winning more trades than you would be winning with the bigger win system, right? Because go back to here, we know that as our win rate increases, our risk to reward decreases. And in the same way, if we have a small risk to reward, we know that, depending on, again, your strategy, you can have a big win rate. Right. And that's the same as being seen here with the smaller win system. It allows you to target small wins, right? A 1 to 3 is going to be smaller than the 1 to 10 that was initially being targeted. But that gives you the ability to win more often, which is psychologically is a much better help, right? Than if you're actually losing trade after trade after trade, right? So this is low risk because you're not going to be taking as many consecutive losses if your psychology is not in place. And that can lead to, again, consistent success. Why? It's because your win rate is higher. So you're winning more trades. And that brings us over to our next point, which is going to be frequent gains, right? So because your win rate is higher and on average, you're actually going to be winning more trades than you would with a big win system. That's going to lead to you frequently winning trades, right? And that's going to bring frequent gains into your account, which is incredible for traders to see, especially when you're starting out or you just don't have a grip on your psychology. And it's something that all traders deal with. And you're going to have manageable losses. Why? Because you're going to have lower risk because you're not going to be losing as many trades in a row with that risk reward system. And all of this brings us to more manageable losses between these two systems. So you may be asking yourself now, which one is better, right? Is it going to be option one or is it going to be option two? And it truly depends because it all boils down to one of the most important topics when it actually comes to trading, which is going to be your psychology in the market. And that's going to be the factor of whether it makes or breaks you as a trader. So here, trader A, which is going to be you, has great psychology in the market. And as a return, you're making all of this money in the market. Why? Because you're consistently successful compared to trader B, who's more of an emotional trader and his psychology is not in check. So he's not making the type of money or any money at all that you're making. So what's the bridge to this, right? So what's the bridge to this psychological aspect that can come from really both strategies, but more so triggered by the big win strategy? So how can we bridge this gap between our psychology and actually becoming this trader and making money from the market? For me, and my other traders as well, if this will allow me to zoom in perfect, be able to achieve this through a algorithm. And I know this is a new topic because a lot of people have no idea what this is or what I'm talking about with this, but there's three benefits that I want to highlight when it comes to algorithmic trading. And for me, that's going to be hands-free because you're telling the computer and you're giving it a code exactly what to trade. So this is going to allow you to cut out your emotions because it's not you actually trading. And that's going to be the mad you when you're trading, or better said, the unprofitable you. That's going to be able to cut him out of the market and turn towards this profitable version of you. Why? Because emotions are no longer at play. And this is going to bring consistency as well. And a simple reason why you're going to be able to be consistent is because that computer is going to trade the same exact strategy for you every single day as long as it appears in the market. And the reason why consistency is so important is because you're able to actually start compounding your trades, right? And if you guys saw the last video, why 3% beats 10% in trading, is simply because when you are aiming for a consistent strategy, right? A smaller win rate strategy that's more achievable to obtain, then you can consistently hit this figure. And over time, your account will actually start to compound and grow exponentially because you're consistent. And you're consistent because you're emotionless when you're trading because you're actually trading hands free. Because it's just human nature to be emotional, like this guy is, when you're trading. It's human nature. You get excited when you make money and you get sad when you lose money. That's human nature. So it's best to cut out emotions and human nature as much when trading. And of course, this leads to you to having profit in the market and consistently being profitable in the market. So this is how I have found to continue to have profitability and to continue to have success in the market by turning over to the algorithm that I've been able to develop, which leads to my consistent success in the market. So when it comes over to why small wins actually beat big wins in trading, it's simply because with small wins, you'll be able to manage your psychology and your emotions much better than a big win system, especially when you're first starting out, because the psychology of losing a lot of trades in a row will start to wear on you at times, and it's going to lead to a lot of different factors, whether those factors are going to be over trading in the market or hesitation or a host of other different psychological issues that actually bring your profits. It's not how you spell profits, that bring your profits over time in the market down. And that's why I tell all traders that are beginning or haven't seen consistent success to just target small wins and have a larger risk to reward system than targeting the bigger wins, right? And having a lower risk to reward system not risk to reward, but having a lower win rate system, simply because you winning more trades, right, and having more profitable setups that you're going to take advantage of, that will increase and better your psychology and keep you from making a lot of these mistakes that comes with psychology. And for those that still want to go further when it comes to mastering your psychology, I have a completely free Discord for every trader to join. And I have a masterclass in there and more information to come on exactly how your algorithm trading can cut out the emotional aspect of trading and make you consistent in the market so you can profit and change from this trader over here and start becoming the trader that you always are.